So we are continuing with overview of model tax convention, and we are technically comparing OECD model versus United Nation model, and we are trying to learn certain similarity, common factors. At the same time, we will see what are the differences between OECD model and United Nation model. So chapter 2 of the convention defines certain terms. One of the most important term, mark it very important from examination perspective, definitely this will be targeted. So the concept of resident. Now sir, is it possible that person may become resident in two countries? Yes, because in India you are having lot of conditions. Condition of 182 days, condition of 60 days plus 365 days, and then there is the deemed residence also. So likewise the foreign country will also have certain criteria. So because of number of days stayed, it is possible that individual may become a resident of both the countries, both the contracting state. Now when person become resident in both the contracting state, it is very difficult to apply the global taxation rule, because if global income become taxable in India as well as global become taxable in foreign country, obviously this individual is not going to pay this much amount of tax. We need to have some kind of relief, some kind of relaxation, and the relaxation will be provided in the country of residence. The double taxation avoidance agreement, please understand, will be applicable from that country. Double taxation avoidance agreement will be applicable in that country. The relief will be given by that country where he is a resident. But in my situation, the person is a resident in both the countries, sir. Then what we have to do? So we are having tiebreaker rules here. Though the rules are very important to understand and learn. Resident of either of contracting state. Obviously to take the benefit, he has to be resident of one or both of the contracting state. A taxpayer has to demonstrate that he is a resident of one or both of the contracting state to able to gain the access to the tax treaty and avail the benefit thereunder. Obviously there is a concept of tax residency certificate. Meaning of resident of the contracting state means any person who under the laws of that state is liable to tax therein by reason of his, what are the primary reason? Domicile or his residence or any other similar criteria or place of management or place of incorporation. Place of management and place of incorporation is applicable for company, firm, LLP, this kind of organization. Domicile and residence is usually applicable to individuals, please understand, and any other similar criteria of that nation. In our India, you know that we have the domicile and residence rule based on number of days stay in India, and for partnership firm, for LLP, we are having the management criteria. If management is wholly or partly in India, then firm and LLP becomes a resident. Place of incorporation is applicable for domestic companies. Domestic companies are always resident. Foreign company can also become resident if there is a poem in India. Place of effective management is located in India. So we use all these factors to cover the residential status chapter. The term, however, does not include any person who is liable to tax in that state in respect only of income from the source in that state or capital situated therein. Obviously, in India, if non-resident comes, say for example, some cricketer has come to India, Bratley has come to India and he has earned certain income in India, please understand, then Bratley is not a resident of India. He has earned income and is going to pay tax only on the source of this particular nation, not on the global income. Okay. OECD model convention does not contain a reference to the place of incorporation. So in OECD model, they don't have the place of incorporation law. Obviously they are developed nations, so they might have their own rules of determining residential status. Now next one, what is the tiebreaker rule, sir? Tiebreaker rule is when individual is a resident of both the countries. Okay, so what steps we have to follow, and please understand, you have to follow this step in order given. You cannot change the order of the rule. You have to follow exactly same order. Okay, in case of individuals, we are learning first, where individual is a resident of both contracting state as per the domestic tax laws of that contracting state, then his residential status shall be determined by applying the tiebreaker rule in the following sequence. Sequence has to be followed. That is very important. So please learn this rule from this whole lecture. The tiebreaker rule is most important one. So first we will check where he is having permanent home. If the permanent home is in India, then he is a resident of India. If the permanent home is in foreign country, then he is a resident of the foreign country. Then the question may arise, because this person is staying sometime in India and sometime in foreign country. London as an example, many Indians are having their second home in London. So they are having home in India, they are also having home in London. So then what will happen now? We are not able to apply the first rule of tiebreaker. Okay, if it was solved, then matter was resolved. If he had only a permanent home in India, then he was a resident of India. Okay, then we will ignore the foreign country. But in my case, he's having permanent home in both the countries. If that is the case, then we have to check center of vital interest. So what is the center of vital interest, sir? Now, interest can be of two types: commercial interest and personal interest. Personal interest means he is having family. Say for example, his grandfather, grandmother, mother, father, wife, kid, everybody is there in India only. Whenever he travels for business transaction in London, he stays in London house. Majority time he is there in India only, isn't it? Apart from that, sir, he is having a lot of economic transactions in India. Please understand, he is having lot of economic. He is having businesses, house properties, investment. So meaning thereby he is preferring India over foreign country. Yes, definitely in foreign country also he is having some income, but that is not vital. Vital means major, okay, primary income, primary interest, where he is having the vital interest. So sometime it may happen that his grandparents are there in India, but his parents are there in foreign country, okay, and his wife travels with him only. Or one or two kids are there in foreign country, one kid is there in India. So now we are unable to understand whether he is having vital interest in India and vital interest in the foreign country. Okay, so second rule is also not able to give you the justification. Then we have to jump to the third rule. Third rule is habitual abode. So what do you mean by habitual abode? Now when I used to work, when lockdown was not there, I used to work in multi-state. I used to work in Gujarat, I used to work in Bangalore, I used to work in Kerala, different states, isn't it? But after completion of the batch, after completion of the work, every time I used to go back to Mumbai. Similarly, whenever this person is having house in both the countries or many countries for that matter, whenever he travels, where he goes back again and again, where he goes back, if he comes back to India again and again, obviously his habitual abode is India. Habitually he resides in India. That means more frequently he visits India, and generally he considers mentally that this is my permanent home, kind of, where he has to go back. Okay. So that is habitual abode. Sir, habitual abode we are not able to determine. Okay. Then the fourth one, unfortunately the fourth one should not be taken as the basis. The basis are actually primary three. First one is permanent home, second one is center of vital interest, third one is habitual abode, fourth one is nationality or citizenship. If obviously he will be having passport of one of the country. If he is having passport of India, he is a citizen of India, then citizen of India will become resident of India. And if he is having foreign citizenship, then he will become a resident of the foreign country. But nationality is given fourth importance, because sometimes foreign nationals become Indian resident and Indian citizens becomes non-resident. You know that very well through the residential status rule. We are having foreigners who are resident in India and Indians who are non-resident in India. So nationality is the last one. Sir, we are not able to follow even nationality rule. He is having nationality or citizenship also of two rules, or we are not able to understand where he is having actual the residential status. This is not a viable basis. These four bases are not viable basis. Then obviously that person must be of serious tax involvement. Then only this kind of issues may arise. So what will happen now? The country one, say for example India, it will have the representative, and foreign country will also have the representative called competent authority. Competent authority of India and competent authority of the foreign country, they will sit together. In India, competent authority can be CBDT or representative of the CBDT. Similarly, the foreign country will send their competent authority. They will sit and discuss where should we finally, please understand, where should we finally justify his residence. So that will be on mutual discussion. Okay, mutual agreement between the competent authority, we call it MAP. Okay, mutual agreement procedure. Okay, of the contracting state. According to that, it will be justified finally. So for individual, we are having rules. We are having tiebreaker rule. For company type of associate or for non-living entities, it is more difficult because sometimes they incorporate entity in one country and they operate in another country. You know that how they play. So India is having very clear rule of residential status. Let me remind you the rule of residential status that we are having in India. We are having section 6 subsection 3 for companies. Okay. For company, what is the rule? There are two types of company. One is Indian company, one is foreign, and another company is foreign company. For Indian company, because it was incorporated in India, country of incorporation is India. Definitely whether it is poem is located in India or outside India. Please understand, whether poem is located in or outside, in both the cases it is resident and resident. You know that. Okay. But for foreign company which is incorporated outside India, it might become resident in India if poem is in India. Please understand, if poem is in India, even this company becomes a resident. If poem is outside India, then only it becomes non-resident. So what you need to understand, in India we have adopted two conditions of residential status for company type of processes. One is in country of incorporation and second one is country of management. Okay. Now country of management rule applies to the foreign companies, and country of incorporation rule we are applying to the Indian companies. So you can understand, this foreign company may become resident in India, also it is a resident in that country where it was incorporated. It is definitely possible, and therefore please understand, foreign company can become resident of that foreign country and it can also become resident of India. At the same time, an Indian incorporated entity, please understand, entity which is incorporated in India is a resident in India, but that entity is having poem in foreign country. Indian company is having poem in foreign country, and according to the foreign country's rule, it is also resident in foreign country. You are getting this? So it is possible that a company is resident in India because it was incorporated in India. A company is a resident in the foreign country because poem is located in the foreign country. Okay. Then what will we do, sir? Obviously, we will call upon the meeting and both the people will sit together. Both the competent authority will sit together and they will, evaluate the rules. And the rules will be evaluated on the basis of tax avoidance practices adopted by these entities. Okay. Dual residence arises where one contracting state attaches importance to place of incorporation and other contracting state to the poem, place of effective management. The tiebreaker test involves a case by case approach. So it's not a standard blanket model for all. Every case is a unique case. You have to evaluate what has happened in that case, considering the number of tax avoidance cases involving in dual residence companies. Request has to be made by the taxpayer through the Article 25, that is mutually agreement procedure. Competent authorities will rely on the range of factors to resolve the questions of a dual residency. So they will discuss and they will come up with a solution. Article 5, permanent establishment. This is also very, very important article. You need to remember this article. So why article permanent establishment is important? We have discussed that, but just to give you again repetition. Income Tax Act focuses on business connection concept. According to section 9(1). If you are having business connection in India and even if you are a foreign entity, non-resident, still your income will become taxable in India. This is one understanding. Okay. But according to DTAA, Double Taxation Avoidance Agreement, they don't follow on concept of business connection. They follow the concept of permanent establishment. If you are having a permanent establishment in India, then only income will become taxable in the source country. Otherwise, this particular income will become taxable in the residence country. This is applicable for business income definitely, because place of permanent establishment is very important only for business entities, not for the income from house property or dividend and interest income. So I'm talking about business income. Am I clear? Now business connection concept is quite wider. It will bring it in taxation. Even if they are not having any physical presence in India, still the foreign company might become taxable in India. But for DTAA, a foreign company will become taxable in India only and only when they are having P in India. Therefore, you should understand what they mean by permanent establishment. There should be an enterprise. Obviously, it is applicable to enterprise. Such enterprise should be carrying on the business. This is the second condition. There should be a place of business. There has to be a place of business. Such place of business should be at least at the disposal of the enterprise. So disposal of enterprise means control of that particular premises should be in the hands of enterprise, mainly owned or rented, but must be the one which the enterprise has the effective power to use. Place of business should be fixed. It should not be temporary, it should not be shared, it should be fixed. It must be established that distinct place with certain degree of permanence. The business enterprise is carried on the wholly or partially through the fixed place of business. Obviously, business is carried on through this particular business, and when all the conditions are complied, it becomes a permanent establishment. A permanent establishment does not exist unless all the aforesaid conditions are satisfied. So please remember this condition again. There has to be enterprise entity. That entity must be engaged in a business. There has to be the place of business. That place of business should be at the disposal of the enterprise. The power should be there. It should be fixed. Some kind of certainty has to be there. And business has to be carried through such place of business. Then only we will say it is a permanent establishment. Sir, some examples of permanent establishment which are included. A branch can be called as a permanent establishment. A place of management can be called as a permanent establishment. An office can be a permanent establishment. A factory building can be a permanent establishment. A workshop can be a permanent establishment. A mine, oil, gas, well, quarry can be a permanent establishment. These are the examples. These are not an exhaustive list. These are just the illustrative list of permanent establishment. So expansion of scope of agency. Now you know that earlier before amendment, what used to happen? Only if your agent concludes the contract for you. Please understand, we have discussed this whole understanding of agency in section 9.1, taxation of non-resident, but let us revise that. Earlier, if your agent is a dependent agent and he is concluding contract for you, then only India is to have permanent establishment. So how non-resident people have evaded the taxes? They will have dependent agent in India. This dependent agent will play the principal role in concluding the contract, but he will not conclude the contract. Contract will be concluded by the non-resident. Final conclusion will happen by the non-resident. He will help, he will assist in all the principal factors. That means major role was played by this particular agent, but the conclusion was not done by the agent. Therefore, they were escaping from the permanent establishment concept. And you know that if permanent establishment does not fall in India, the non-resident is not liable to pay tax in India according to the TAA, isn't it? So they have expanded the scope in 2017. Please understand, all this amendment has taken place in 2017 in OECD model. Okay, OECD and United Nations model, globally they have, because it's not only India which has suffered. All major countries have suffered because of this multinational companies. They have done the planning for every country. So they have amended the treaties in 2017. According to that, Indian laws are also amended, and now Indian law has expansion of concept of agency of permanent establishment. Okay, the agency permanent establishment targets activity done by the dependent agent of the enterprise in the source state. Source state means India. DEP. So what do you mean by DEP? Dependent agent permanent establishment. DEP now includes instances where an agent habitually concludes the contract. It was already there. Or this is very important, habitually plays a principal role leading to conclusion of the contract. So he is not concluding the contract, but he is playing a very vital important role in concluding the contract, routinely concluded without material modification by the enterprises. Sir, this is also important. Place of permanent establishment for insurance enterprises. So if they are having agents in India, there is one insurance company outside India, please understand, and they are having agents in India who are doing business on behalf of this insurance company, collecting documents, collecting check, collecting premium amount. In case of claim, they are helping the insurer to get the claim, everything. So obviously they are having business connection in India, and their income attributable to this agent will become taxable in India. But this clause is not applicable for reinsurance. It is only applicable for insurance. Okay. OECD model does not have any specific clause for insurance companies. So please understand that it is only there for United Nations. I have told you earlier also, United Nations model favors the source rule of taxation, and OECD model favors the residence rule of taxation. So for insurance companies, OECD model does not have any specific rule, meaning thereby this agent income will not be taxable in the country of source. This agent income will be taxed in the country of residence. Okay, that is according to OECD model. In the absence of similar article in the OECD model convention, a permanent establishment of insurance enterprise is to be determined according with Article 5.1 and 5.2, earlier article that we have just now discussed. Now let us talk what is there for specifically for United Nations. United Nations Model Convention has an additional Article 5.6 relating to the insurance. An insurance enterprise of the contracting state is deemed to have permanent establishment in other state. So this company will be considered as a deemed to have permanent establishment in other state if it collects premium in the territory of that other contracting state or insures the risk stipulated therein through a person, that is agent. But this clause is not applicable for reinsurance. Okay. This is not applicable for reinsurance. Reinsurance means when insurance company takes insurance, that is reinsurance. So these are the few more definitions we have discussed. Very important. This lecture is definitely important from your examination perspective. Have control over it. Thank you.